Ladies and gentlemen, imagine waking up one morning to find that everything you've worked for is gone. Your savings vanished, your home under threat, your future uncertain. Now imagine at that exact same moment somewhere else in the world, a small group of people are celebrating. Not because they built something great, not because they served humanity, but because they saw the storm coming and positioned themselves to profit from the wreckage. This is the uncomfortable truth about financial crashes. They don't destroy wealth, they transfer it. When markets collapse, when fear spreads, when headlines scream disaster, most people panic. They sell at the bottom, they freeze. They hope things will magically recover, but a tiny fraction stays calm. They study patterns, they understand cycles, they recognize that chaos is not the end, it's an opportunity. And so while millions are losing everything, they are quietly buying assets at a fraction of their value. While others are running away from the fire, they are walking toward it with strategy, with patience, and with knowledge. That is how 847 families become richer, while 12 million are left picking up the pieces. But this isn't just about money, it's about awareness. Because the real crash doesn't start in the market, it starts in the mind. The moment fear overrides logic, the moment you follow the crowd instead of thinking for yourself, the moment you react instead of preparing, that's when you've already lost. History has shown this pattern again and again. Booms create confidence. Confidence creates complacency. Complacency creates risk, and risk, when ignored, creates collapse. And every time the same story repeats. The majority pays the price. The minority collects the reward. So the question is not whether another crash will come. It will. The real question is, when it does, which side will you be on? Will you be among those who are shocked, unprepared, and overwhelmed? Or will you be among those who understood the game, who saw the signals, who moved with intention? Because in every crisis there are two kinds of people, those who are victims of the moment and those who are students of it. The difference is not luck. It's not background. It's not even resources. It's mindset. The ones who win during chaos are not the ones who have the most. They are the ones who understand the most. They learn when others ignore. They prepare when others celebrate. They act when others hesitate. So instead of fearing the next crash, prepare for it. Educate yourself. Control your emotions. Question what everyone else blindly follows. Because the harsh reality is this: the system doesn't reward the loudest voices. It rewards the most disciplined minds. And when the next storm arrives, and it won't ask for permission. It will reveal who was ready and who was not. So don't wait for the headlines to tell you what's happening. Don't wait for the crowd to decide your future. Start now, because the difference between losing everything and gaining everything is often decided long before the crash ever begins. When most people hear about a financial crash, they imagine wealth being wiped out, as if trillions simply disappear into thin air. But the reality is far more unsettling. Wealth is rarely destroyed, it is moved. It shifts hands, often quietly and systematically, from those who are unprepared to those who understand how the system works. What looks like loss on one side is often gain on another. For every person selling in fear, there is someone else buying with confidence. In times of crisis, panic becomes contagious. News spreads quickly, emotions run high, and people begin to act based on fear rather than logic. They rush to pull out their investments, sell their assets at drastically reduced prices, and try to protect what little they believe is left. But in doing so, they often lock in their losses. They exit the game at the worst possible moment, handing over valuable assets to those who have been waiting patiently for such an opportunity. Meanwhile, a smaller, more calculated group operates differently. They don't react emotionally to the chaos. Instead, they anticipate it. They understand that markets move in cycles, periods of growth followed by correction. When prices fall, they don't see disaster. They see discounts. Assets that were once overpriced suddenly become accessible. Businesses, stocks, and properties are available at a fraction of their previous value. And while the majority sees risk, this minority sees potential. This dynamic creates a powerful transfer of wealth. Those who are driven by fear unknowingly pass their financial positions to those driven by strategy. It's not always about having more money, it's about having the right mindset at the right time. The individuals who benefit from crashes are often the ones who stayed informed, kept cash or liquidity ready, and trained themselves to act rationally when others could not. Another critical factor is timing. During stable periods, many people feel confident and invest without much thought, but they fail to prepare for downturns. They don't consider what they will do if the market drops significantly. So when it does happen, they are caught off guard. In contrast, those who understand that downturns are inevitable prepare in advance. They plan their moves, set their strategies, and wait. When the crash finally arrives, they are not scrambling, they are executing. This is why the idea of wealth being lost can be misleading. The total value doesn't simply vanish, it is redistributed. The system rewards those who are patient, informed, and emotionally disciplined, while it punishes those who act impulsively. The gap between these two groups widens dramatically during times of crisis. Understanding this changes everything. It shifts your perspective from fear to awareness. Instead of seeing a crash as purely destructive, you begin to recognize it as a moment of transformation, one where positions are reshuffled and new opportunities are created. And once you see it that way, you start to realize that the outcome is not random. It is shaped by how people think, how they prepare, and how they respond when the pressure is at its highest. Fear has a way of taking control before you even realize it. It doesn't arrive loudly. It creeps in through uncertainty, through negative headlines, through the behavior of others around you. And once it settles in, it begins to shape decisions in ways that feel logical in the moment, but turn out to be deeply damaging over time. In financial crises, fear becomes the invisible force that drives millions of people to act against their own best interests. When markets begin to fall, the first reaction for many is disbelief. People tell themselves it's temporary, that things will bounce back quickly, but as the decline continues, disbelief turns into anxiety. Numbers on screens keep dropping, news outlets amplify worst-case scenarios, and suddenly the pressure becomes overwhelming. That's when fear takes over completely. It convinces people that the safest move is to get out immediately, no matter the cost. So they sell. They sell assets that took years to build. They sell at prices far below their true value. And most importantly, they sell at the exact moment when the damage is already done. What they don't realize is that by acting on fear, they are turning a temporary loss into a permanent one. The market may recover later, but they are no longer part of that recovery. They have locked themselves out of the opportunity to regain what was lost. Fear doesn't just push people to sell, it also paralyzes them. Some individuals become so overwhelmed that they do nothing at all. They avoid looking at their accounts, avoid making decisions, and hope that the situation will somehow fix itself. But inaction driven by fear can be just as harmful as impulsive action. Opportunities pass by unnoticed. Valuable moments to make strategic moves are missed, and while they remain stuck, others are moving forward with clarity and purpose. Another powerful effect of fear is herd behavior. People begin to look at what everyone else is doing and assume that it must be the right thing. If everyone is selling, it must be smart to sell. If everyone is panicking, then panic must be justified. This collective reaction creates a cycle where fear feeds on itself. The more people react emotionally, the worse the situation appears, and the worse it appears, the more people react. What makes this even more dangerous is that fear narrows thinking. It reduces the ability to see long-term possibilities and focuses only on immediate survival. Instead of asking, what is the smart move over the next 5 years? People ask, how do I stop the pain right now? And that shift in thinking leads to decisions that sacrifice future gains for short-term relief. Those who manage to avoid these traps are not immune to fear. They simply control it better. They acknowledge the uncertainty, but they don't let it dictate their actions. They rely on preparation, knowledge, and a clear strategy to guide them through the chaos. While others are reacting emotionally, they are responding intentionally. In the end, fear is not just an emotion, it is a decision-making force. It determines whether someone holds or sells, acts or freezes, follows the crowd, or thinks independently. And during a crash, that difference in behavior can mean the difference between losing everything and positioning oneself for future recovery and growth. A small group of people consistently manages to come out ahead during times of crisis, not because they are lucky, but because they are prepared long before the chaos begins. While most individuals are focused on the present, enjoying rising markets and assuming the growth will continue, this minority is quietly studying patterns, learning from history, and building strategies for moments when things go wrong. They don't wait for a crisis to react, they expect it. Preparation for them is not a one-time action, but a continuous process. They analyze past downturns, understanding how markets behaved, what signals appeared before the collapse, and how long recoveries typically took. They pay attention to warning signs that others ignore: overvaluation, excessive optimism, unsustainable growth. While the majority sees opportunity in a booming market, they also see risk building beneath the surface. Another key element of their preparation is liquidity. They ensure that they have access to capital when it matters most. While others invest everything during good times, leaving themselves exposed, this group maintains reserves. It might seem counterintuitive to hold back when everything is rising, but this discipline allows them to act decisively when prices fall. When assets become undervalued, they are not scrambling to find money. They are ready to deploy it. Emotional control is another defining trait. During a crash, the environment becomes chaotic. Prices drop rapidly, news cycles turn negative, and uncertainty dominates every conversation. Most people feel the pressure and react instinctively, but this small group has trained themselves to remain calm. They don't ignore the situation, they simply refuse to let emotions override their strategy. They understand that panic is temporary, but decisions made in panic can have permanent consequences. Because of this mindset, they are able to see what others cannot. Where the majority sees danger, they see opportunity. When quality assets are being sold off at discounted prices, they recognize the long-term value. They understand that markets eventually recover, and those who invest during downturns are often the ones who benefit the most during the rebound. This perspective allows them to act with confidence, while others hesitate. They also think in terms of probabilities rather than certainties. They know they cannot predict the exact timing of a crash or the exact bottom of the market. Instead of waiting for perfect conditions, they focus on making calculated decisions based on available information. They spread their risk, make gradual moves, and position themselves in a way that increases their chances of success over time. Another advantage they hold is independence in thinking. They are not easily influenced by public opinion or media narratives. While others look outward for validation, they rely on their own research and understanding. This independence protects them from herd behavior and allows them to move in the opposite direction when necessary. All of these factors combine to create a powerful advantage. By the time a crisis hits, they are not reacting. They are executing a plan that was already in place. While millions are trying to figure out what to do, they are already doing it. And because they prepared when it was easy, they are able to act when it is hard, turning moments of widespread fear into opportunities for growth and long-term gain. It is easy to assume that the people who come out ahead during a financial crash are simply those who have the most money to begin with. At first glance, it looks like a game of resources. Whoever has deeper pockets survives, and whoever doesn't, loses. But when you look closer, a different pattern emerges. Time and again, individuals with modest resources outperform those with far more simply because they think differently. Their advantage is not their starting point, it is their mindset. Money without discipline can disappear quickly, especially in uncertain times. A person may have significant wealth, but if they lack emotional control, they can lose it just as fast as anyone else. Fear, greed, impatience. These emotions do not discriminate based on how much someone owns. In fact, the more someone has, the more they may fear losing it, which can lead to even more impulsive decisions. This is why mindset becomes the true foundation of financial resilience. At the core of this mindset is the ability to stay calm under pressure. When markets are stable, it is easy to feel confident and rational. But when everything begins to fall apart, that confidence is tested. Prices drop, uncertainty rises, and the pressure to act becomes intense. Those who rely only on resources often react emotionally in these moments, but those who have trained their thinking remain steady. They understand that chaos is temporary, and that reacting too quickly can turn a manageable situation into a disastrous one. Another important aspect is discipline. Having knowledge is one thing, but applying it consistently is another. A strong mindset allows individuals to stick to their strategies even when it feels uncomfortable. For example, continuing to invest during a downturn can feel counterintuitive. Every instinct may be telling you to stop, to wait, or to pull back. But disciplined individuals recognize that some of the best opportunities arise during these exact moments. They follow their plan, not their fear. Patience also plays a crucial role. Many people want immediate results, especially when they are under pressure. They look for quick fixes to recover losses or escape uncertainty. But those with the right mindset understand that real gains often take time. They are willing to wait, to let their decisions play out, and to trust the process they have built. This long-term perspective protects them from making short-term mistakes that could cost them dearly. Self-education is another key factor. Instead of relying solely on external advice, individuals with a strong mindset take responsibility for understanding what they are doing. They learn about markets, cycles, risks, and opportunities. This knowledge gives them confidence. Not the blind confidence that leads to overconfidence, but a grounded confidence that comes from understanding. It allows them to make decisions based on logic rather than emotion. Perhaps most importantly, they take ownership of their actions. They do not blame the market, the system, or other people when things go wrong. Instead, they analyze their decisions, learn from their mistakes, and adjust their approach. This continuous improvement strengthens their mindset over time, making them more prepared for future challenges. In contrast, those who rely only on money often overlook these qualities. They assume that resources alone will protect them, but without the mindset to manage those resources wisely, they remain vulnerable. The true difference, therefore, lies not in how much someone has, but in how they think, how they react, and how they prepare themselves mentally for uncertainty. By the time a financial crash becomes visible to everyone, most of the critical decisions have already been made, just not consciously. The outcome people experience during a crisis is usually the result of habits, knowledge, and preparation built long before the downturn ever begins. What looks like sudden loss or unexpected success is often the delayed effect of earlier choices. This is why preparation is not just helpful, it is decisive. During stable and booming periods, most people feel comfortable. Markets are rising, opportunities seem endless, and there is a general sense of security. In these moments, preparation feels unnecessary. People take on more risk, invest without fully understanding what they are doing, and assume that growth will continue indefinitely. The idea of a crash feels distant, almost irrelevant. But it is precisely in these calm periods that the foundation for future outcomes is being set. Those who eventually struggle during a crash often do so because they did not prepare when they had the chance. They didn't build a clear strategy. They didn't consider worst-case scenarios. They didn't ask themselves how they would respond if their investments dropped significantly. So when the downturn arrives, they are forced to make decisions under pressure without a plan, and decisions made under pressure are rarely the best ones. In contrast, those who navigate crises successfully begin preparing when everything still looks good. They recognize that growth phases do not last forever. Instead of becoming overly confident, they become more cautious and thoughtful. They assess their risk exposure, diversify their assets, and ensure that they are not overly dependent on a single outcome. This doesn't mean they avoid opportunity. It means they approach it with awareness. One of the most important aspects of this preparation is clarity. Knowing what you will do before a crisis happens removes uncertainty when it matters most. If the market drops by a certain percentage, what is your plan? Will you hold, sell, or invest more? How much risk are you willing to tamel? These questions, when answered in advance, create a sense of control even in chaotic situations. Without this clarity, people are left reacting to events rather than managing them. Another critical element is emotional preparation. It is one thing to say you will stay calm during a downturn, and another to actually do it when your finances are on the line. Those who prepare mentally understand that volatility is part of the process. They anticipate the discomfort and accept it as normal. This makes it easier for them to stick to their strategy when others are overwhelmed by fear. Financial flexibility also plays a role. Having reserves, avoiding excessive debt, and maintaining liquidity provide options during a crisis. Without flexibility, even the best strategies can fail because there is no room to act. Preparation ensures that when opportunities arise, there is the ability to take advantage of them. Ultimately, the difference between those who lose and those who gain is rarely decided in the middle of the crash. It is decided in the quiet moments before it, when no one feels urgency, when no one is paying attention, and when the right actions are easiest to take but most often ignored. Those who use that time wisely position themselves to respond with confidence, while others are left trying to recover from decisions they never prepared to make.